Thank you, thank you. My name is Paul Downs. I'm a barrister at Quadrant Chambers, and I've been practicing in accountancy and banking sort of disputes for around 30 years. And this QBiT talk is called How to Analyse a Profit and Loss Account. If you haven't watched the first QBiT talk in this series on how to analyse accounts, you might want to watch that first, because that's an introduction, particularly to the balance sheet, which is the most important financial statement. But this talk is about the profit and loss account. And the profit and loss account links the balance sheet. So you can imagine you have a balance sheet for year one here and a balance sheet for year two here. They are the snapshot of a business at that particular point in time. All of the assets, all of the liabilities are listed in balance sheet one and then in balance sheet two. And a year separates them. The profit and loss account summarizes all of the trading transactions between that balance sheet and that balance sheet. So it gives you more insight into what's happening in the business. And remember, if the business is profitable in general terms, the net assets will go up. And in general terms, if the business is loss-making, the net assets will go down. Now, profit and loss account really in three sections. Just want to explain the structure of the statement. At the very top, the first three lines, we have the calculation of the gross profit. You really need to know what gross profit is. I'll come to it in a moment, but that's the first part. Then the middle part of the profit and loss account is all about calculating the net profit. That's the profit that is the result of the normal trading. And then the final part of the balance sheet, what we would refer to as below the line items, are all of the items, all of the transactions that fall outside of the normal trading of the business. So the payment of tax is below the line. Exceptional items, items that are one-offs, that are not going to happen year in and year out. That's the structure of the profit and loss account. And before we look at how to study the numbers, just want to go through some of the vocabulary, because understanding the meaning of the words is quite important. Firstly, most profit and loss accounts don't use the user-friendly term sales, which we'll all understand. They use another term, which is turnover, but it just means exactly the same thing. Turnover is the same as sales. The next concept is variable costs. Now, variable costs are those costs which go up exactly in line with the sales. Let me give you an example. Let's say that I'm a newspaper vendor and that I sell newspapers at £1 per newspaper. And in a year, I sell 100,000 newspapers. That's £100,000 of turnover. My direct cost is one thing and one thing alone. My variable costs are the costs of buying the newspapers. Let's say that they cost me 50 pence per newspaper to buy. That means that the variable costs, direct costs, it's the same thing, are 50 pence per newspaper. The next expression I want to explain is the gross profit or the gross margin. That is the difference between the turnover and those variable costs or direct costs or the costs of sales, all the same thing. So we take the sales, we take off those variable costs, and we end up with the gross profit. And if we divide the gross profit by the sales, we get a percentage, and that's called the gross profit percentage, or the gross margin. Again, exactly the same concept. Now, below that top part of the balance sheet, we have fixed costs, and fixed costs are everything that isn't a variable cost, even though they might vary a little bit over time. Below the items, we have items such as interest, tax, exceptional items, dividends as well. Exceptional items are really important because you could have a business that makes a huge loss in 1 year, but when you look at it, the trading part of the balance sheet is generating profit, and it's just that they had a one-off hit in that particular year. So generally speaking, you can strip out the exceptional items to work out how the profitability of the business is. So let's imagine, shall we, our newspaper vendor and what their profit and loss account might look like. As we've said, they've sold 100,000 newspapers in a year. That's £100,000 of turnover. And their cost of sales, £50,000, because it's 50 pence per newspaper. That means their gross margin or their gross profit percentage is 50%. The fixed costs, in this example, I'm going to say are £25,000. So that's rent, travel, other salaries, wages, that sort of thing, £25,000, which means that there's a net profit at the end of £25,000. There might be some bits and pieces after that, might be some tax to pay and the like. But basically, the business is selling £100,000, and at the very bottom, it makes 25,000. Now there's something quite clever you can do with a profit and loss account once you understand the difference between variable costs and fixed costs, is you can work out where the break even is. The break even is the point at which a business makes zero profit, moves from loss into profit. And all you need to do is take the fixed costs, £25,000, and divide it by the gross profit margin, which is 50%. £25,000 divided by 50% means £50,000. That's the break-even point. And if you think about it, it works. £50,000 of sales, 50 pence per newspaper, that means it will cost them £25,000. That will give you a gross profit of 25,000. Knock off the fixed costs because they don't move. 25,000 gives you a break-even point of 0. So when we look at a profit and loss account, we can't just really look at just 1 year. We've got to look at trends. And most people will say the minimum number of years you need to look at are 3 years. So let's just think of an example of a business, this newspaper vendor, and think of it over 3 years. Let's say the turnover is rising over time. 100,000, let's say, then 120,000, and then 140,000. So you look at that and you think that's a very successful business. It's growing its sales faster than inflation. But if we look then at the cost of sales and see what they're happening, let's imagine they go 50,000, 65,000, 80,000, which would mean that the gross profit was 50,000, 55,000, 60,000. Something is rather odd here, because the gross profit margin, that's the percentage of gross profit to sales, is falling. It starts out at 50%, then it goes to 46%, and then 43%. Now, why is that happening? Normally, businesses will mark up on a consistent basis. So we can speculate. Is this business facing competition? Is its cost of buying these newspapers in going up, but it can't put its own prices up because there's another vendor around the corner who's competing? Or maybe the cost of newspapers isn't going up, but it's facing stiff competition, so it's having to slash its costs in order to survive. Or sometimes it points to somebody in the business who's dishonest, somebody who's stealing the newspapers and selling them out on eBay. I don't know how you quite do that, but anyway, let's assume they were. Because then what's happening is that there's newspapers that are being bought in that are featuring the cost of sales, but they're not getting through to the turnover line. So that is distorting and depressing the gross margin. We think of the fixed costs. We would expect the fixed costs to stay stable over time. Let's assume that they're going 25,000, 30,000, 40,000. That's quite an increase, a 20% increase, a 33% increase, much, much higher than inflation. What's going wrong there? Another thing we might think about when we look below the line is to see what's happening to interest. So if interest is going up, it means the business is borrowing more. And if the business is not particularly profitable, that might be a red flag. In this example, we might think of a business that's paying out more dividends than, in fact, the profit it's earning. That's another warning sign for a business. If they're paying out more in the way of dividends than is being retained in the business, that can leave the business undercapitalized and weak. So it's very easy when you look at a profit and loss account. Number one, look at the sales. Look at the trend. Is it going up? How does that work in terms of what you'd expect to see? Secondly, look at the gross profit percentage. You expect that to be stable. If it's not stable, something's changing in the way that the business buys and sells its goods. And thirdly, look particularly at below the line. Look for exceptional items and things like that that might distort the profit. That is all I think you need to know basically about a profit and loss account in 10 minutes. Thank you for watching.